morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thanks very much for joining us. And joining us for the hour, Brian Madden, our Chief Investment Officer at First Avenue Investment Counsel. And in 30 minutes, Stats Canada will be releasing the latest GDP numbers. We'll break them down with Brian, and we want to hear from you as well on First Call. Reach out with your questions. We'll have Brian answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address, if you want to get in that way, is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you here in the BNN Bloomberg newsroom. U.S. President Donald Trump has threatened to impose 50% tariffs on aircraft from Canada sold in the U.S. Trump also says he will decertify all new planes made in Canada until Ottawa agrees to approve certain jets made by Gulfstream, a unit of General Dynamics. Bombardier says that it has taken note of Trump's post and is in contact with the Canadian government. And Trump says he intends to nominate Kevin Warsh as the next chair for the Federal Reserve. Warsh has previously served on the board. He did so from 2006 to 2011 and was also an economic advisor for the president. Warsh was passed up for the position. Jerome Powell, of course, getting it in 2017. Shares of Apple are holding steady in the pre-market despite the technology giant posting estimate-beating revenue and profit in Q1. The muted response comes as Apple warned about rising component costs, potentially tightening its margins. CEO Tim Cook says sales of the iPhone 17 beat expectations, serving as a major contributor to the quarter's growth. And now our top-line story that we were just talking about. Trump threatening to impose a 50% tariff on aircraft from Canada sold in the U.S. and decertify all new Canadian-made planes until Ottawa agrees to approve certain jets made by Gulfstream. For his thoughts on this developing story, let's bring in our guest for the hour, Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. Brian, thanks as always for joining us on a Friday. And what a surprise, we're talking about Donald Trump.
Another day, the fog of war continues.
Another Trumpism. Is this a taco, or does it feel like something that could stick? Or are we just going to kind of let this one go and we'll deal with it, sort of?
I think a good operating assumption, Roger, is until and unless proven otherwise, everything is a taco. That seems to be the playbook. This in particular, you got to sort of take apart what would be the underlying motive. So, of course, first of all, we know that today's Bombardier is not your father's or your grandfather's Bombardier. It's a stripped down, slimmed down, leaner, and more focused version of what it once was. It doesn't make trains, doesn't make commercial aircraft, it doesn't make skidoos and jet skis anymore. That's all been sort of hived off. So it's a focus, pure play on private aviation with a very small element of military sales in the mix. So. And then you got to think about, who's pulling Trump's strings on this one. So the major rival here is Gulfstream. Who's the owner of Gulfstream? It's General Dynamics. That's one of the 5 big prime defense contractors in the United States. We can well imagine the military-industrial complex in the U.S. is having an absolute field day with the step up in defense spending domestically and globally. So they've probably got his ear. In all likelihood, this is a bluff. An executive order doesn't certify or decertify an aircraft. Federal Aviation Authority does it, and their counterparts in Canada and Europe do it. So this probably goes away. But then, peeling the layer of the onion back a little bit further, the bigger prize here in all likelihood, and this might be what the president has his eyes set on, is the F-35 contracts. That's not a General Dynamics, the Gulfstream parent company contract. It's Lockheed Martin. But Bombardier could have a spoiler role to play here, because we have certainly heard of talks of them pairing up with Giffen, the Swedish competitor to the F-35 aircraft. So this may be a gambit in a bigger, higher stakes game, but in all likelihood, balanced probability, probably a taco.
And would this be enough, do you think, for Bombardier to maybe move more production down to the States, or are they just going to ride this out and see what happens?
Well, because
they have 3,000 people in the U.S. that work for them, and then suppliers all through the U.S. So, they're ingrained down there.
Well, yeah, we've talked a lot about, and this gets way more press, the auto industry being, inextricably linked across the borders. That's even more true of the aerospace industry. I went to Bombardier's new manufacturing facility out near Pearson Airport about 18 months ago. It's a behemoth of a facility and went deep for their investor day. So this industry has one of the most complex supply chains in the world. There's tier 1, 2, 3, 4, and 5 suppliers. There's something like 60,000 parts on an aircraft. So substantively, the majority of the parts for this aircraft are actually being sourced from the US and globally. It's just that final assembly is occurring either at Toronto or near Doral. So this is not a manufacturer that's stealing American jobs in any way, shape, or form, and embargoing this plane would just cause chaos for the bigwigs, who probably also have Trump's ears, who need these planes to go about their business, and moreover would have a ripple effect through the aerospace industry supply chain, which runs deep into the United States.
And do we know what a percentage of the market Bombardier or is this just going after it to appease?
It is, it's the number 1 or the number 2 player. I think what we do know is they have the best aircraft on the market, and I think that's probably what this is getting at. Bombardier is winning in the market because they have the newest, the longest range, the fastest, the quietest, the lowest emission, most comfortable aircraft, and it's winning pound for pound and mile for mile against Gulfstream, its rivals. And I think probably Gulfstream is trying to tilt the playing field in their favor, and so you get the president to
Trump
throw
was
a tweet
happy
in the
to say
ring,
something about something somewhere somehow, and so he's saying this one now.
You got
but
it.
Businesses, it sounds like they'll vote with their wings or with their. I mean, they're going to choose what's better for them, price point, and performance and everything. They're going to still end up picking what's better for them.
Yeah, I mean, you're not buying a bus ticket here. You're buying a $70 or $80 million aircraft, so it's a big ticket purchase, and you choose wisely. And you don't choose just because one wraps itself in the MAGA flag. You choose it based on its performance and specs and capabilities. So I don't think this changes anything in the competitive dynamics. And as I said, it's probably a taco situation again.
All right, we'll leave it on that note there. But coming up, we'll take a look at the markets before the bell. See how things are shaping up on the markets. We'll start with U.S. futures and concerns over Trump's choice for a Fed chair weighing in on the markets right now. You can see they're off all the way across the board. The Dow down by 0.4 right now, NASDAQ by half, and the S&P 500 off by about 0.4 as well. Heading over to Asia, it is a similar situation, but the Hang Seng really taking a hit, some profit taking there, and an eye on what's going on in the U.S. Nikkei off slightly, Hang Seng off by more than 2, and the CSI 300 down by a point. To Europe now. Gains there being driven mainly by solid corporate earnings. Adidas, one of them, leading the way. FTSE up by 0.44, CAC 40 by 0.72, and the DAX up by 0.86. And the TSX from yesterday finished off nearly a half a point, but still above 33,000. Tech and precious metals mining dragging it down for the day, but overall for January, we are still up. Some of the movers and shakers, 5N Plus up nearly more than 19%. I want to say nearly 20, but it's not really. It's more than 19. Rogers up by 5.7%. Celestica down by 13.5%. And Vizsla Silver down by 14.9%. The news of some of their miners being kidnapped down south. And looking at the metals, look at that. Quite a drop right now. Silver is leading the way, if you want to call it that, up by 11, almost 12%, pushing down towards 100. Gold at one point was below 5,000. It's kind of bounced back, so the hit now is it's off by about 4.5%. Copper still above $6, and it is down though about 3% right now, but all of them still up for the last year. And oil. Nice little jump for WCS yesterday, 4.26%, stronger than expected demand. Geopolitical concerns driving this. WTI, taking a look at that. And you can see probably a similar situation. Let's see what it's doing right now. It's bouncing. It's off a little bit, but look what the price is at right now, 65. Just about a month or so ago, it was down to 55 a barrel. It's been recovering on those geopolitical concerns and that demand. Okay, does the leadership of a company matter when investing? Brian Madden, Chief Investment Officer at First Avenue Investment Council, would say yes. And Brian, when we're talking about that, how important is it to you then that it's nice to see somebody in charge who actually started the company or their family started the company? What does it mean to you when you see that?
Yeah, I mean, Roger, it's not the be-all and end-all for us, but I will say my colleagues and I at First Avenue Investment Council do have a strong affinity for investing in family or founder-led, meaning the CEO or the chair of the board companies. And to that end, we actually have a pretty disproportionate outsized exposure to them across our dividend growers and our momentum mandate. Probably about 20% of the stocks that we own are, these family or founder-led companies. And we like them for a number of reasons. And I think probably the strongest reason is you're investing with an entrepreneur. And entrepreneurship is the beating heart of capitalism. Chutzpah, ambition, vision, boldness. These are characteristics we often associate with entrepreneurs. Beyond that, we find that companies that are founder or family-led or controlled tend to have a longer-term orientation than your garden variety company led by a gun-for-hire professional CEO. And so that's kind of interesting because in a sense, these companies can fulfill one of the promises that private equity makes, which is, and we know about this quite well because we have a private equity strategy that we also manage. And so we know from that experience what investing with partners and founders is like. But it's basically they have a long-term orientation and a vision. They think through cycles and they're not worried about quarter-to-quarter variability.
Yeah, they've been through it all
beating
before,
the
right?
numbers and all that sort of thing. The third thing that we like about these sorts of companies is they have skin in the game. So typically the founder or the family will own a lot of stock and actual stock, not just options. And typically they'll tend to have a lot of their net worth invested in the shares. So that ensures shareholder and management alignment. And then lastly, resilience. So the very fact that they have made the leap from startup to a public company means that they've beaten the odds and succeeded where others have failed. And for that, I rely on data from Innovation, Science and Economic Development Canada that shows that half of startup companies fail within their first 8 years. So the very fact that these companies are still led by the founder who made the leap from the garage or the basement or whatever to the public markets means they are resilient and stand the test of time.
Now, what are some of the dangers with this, though, too? I mean, there's that saying, what is it? The first generation makes it, second generation keeps it, third generation loses it. I mean, are there concerns about that they can become complacent too?
Yeah, so that's why you don't necessarily just want to do this blindly and with a broad brush. I mean, we can certainly cite counter examples. One that comes immediately to mind would be Tesla, where, I won't go down the rabbit hole of all the governance woes of that company. Now, to be fair, that hasn't stopped it from becoming a monolith, a huge mega cap company, but I think there are some very real and legitimate governance concerns there. And then you have issues of succession and sort of infighting and battles between different factions. Rogers Communications would be a good example of that. And then you have the shirt sleeves sort of mantra where the founder works hard and hustles and the kids are born with a silver spoon in their mouth and don't have the same hustle and entrepreneurial drive. But so you really want to look closely at it. And finally, the other thing that I forgot to mention is pride. So this applies both to the founder and quite often to the successor generations if they do sort of successfully transition to a second or third generation of family ownership. These companies are not just the place where they work or the place that signs their paycheck if you're a founding family CEO. It is a significant source of pride and often a primary source of their family's legacy. You think about companies like Loblaw, for instance, and it's the long-term orientation is manifest through decades and sometimes extends beyond a century for these founding families.
So what are some of the companies that you like Canadian companies that come to mind, say?
Yeah, and we do. That's a good point. We find more of them in Canada than we do in the United States.
Oh, really? Okay.
So all of the examples I'll say, we own some in the States, but Alamos Gold would be one. Shopify, of course, would be another one. Loblaw is one that we own, like Fairfax Financial, TFI International, Dollarama. And a handful of others sort of fit the bill where either the founder or a successor from that family is either the CEO or the chair in one of those companies, in all of those companies.
And is there like an average generational point, or do you like first and second generation? But you'd mentioned Loblaw, which is now third, fourth generation probably running it. Do you like the companies that are into the first or second generation of running it?
I would say other things being equal, the preference would be to have the actual founder still in the seat. But if the transition is successful and if the succession planning is not simple nepotism, but actually is based on competence, then we're quite happy to invest in a company that's led by a second generation of the founding family, and in fact do own a number of companies like that.
Okay. All right. We're going to talk more about one of them actually coming up after the break when Brian is back. He is the Chief Investment Officer at First Avenue Investment Council. Dollarama is the one we're going to talk about. It's on his radar. Time to see what's on the radar for Brian Madden, Chief Investment Officer at First Avenue Investment Council. And we were talking about it briefly before the break, but Dollarama, you're liking that, Brian?
Yeah, we've liked it for a long time, Roger. I think I've owned it probably in every portfolio I've managed since about 2010 or 2011, which is not long after their IPO in, I think, 2009. It's a real homegrown success story. Started with one store long time ago. It was owned by private equity and then did the IPO in 2009. Bain Capital was the private equity sponsor. But what we're dealing with now is the dominant dollar store franchise in Canada with 1,700 stores. It's ubiquitous. It's almost synonymous with the category. But about 10 years ago, they planted some seeds via a joint venture in Latin America. That's now grown to about 700 stores. They're just on the cusp of having entered into Mexico in the last quarter or two. They own 60% of that joint venture with more of the economics for Mexico, which, needless to say, is a huge addressable market that's lightly contested. And so they have the game to get after that very capably. And then more recently, they, via an acquisition, acquired TRS, which is a terrible name, by the way. It stands for the Reject Store.
Is that the Australian one?
Yeah. So that's the leading dollar store format in Australia. This one, candidly, is a bit of a fixer-upper, but it's a great platform from which to both fix up the existing store footprint in terms of merchandise assortment and in-store experience, and bring the margins up to scratch and the sales productivity per square foot up to Canadian standards and create tremendous value that way. What we like about it is it's got exposure to this sort of K-shaped economy because it is by far and away the low-cost leader on pretty much any single item that they stock. I mean, we were mentioning off-air, they've got lip balms for $3 that Sephora sells for $35. That's just one of about 4,000 examples because they stock about 4,000 items.
You can do a little comparison for us on those two?
You need them in this cold weather we're having. So they have exposure to that sort of strapped consumer. But interestingly, unlike in the United States, the retail concept actually does resonate across income demographics. You'll find Ferraris and BMWs and Porsches in the parking lot.
People know they can go there for certain things, too.
That's right. And it's different in the States. There's a bit of a stigma. The concept skews more rural than urban. That's not the case for Dollarama. So it's a broad-based concept with national resonance. It's a capital light growth algorithm. It's about $2 million to open a store, and the payback period is very, very short. So that allows them great free cash flow, which they use to buy back their shares and increase their dividend. Never been a cheap stock, but it has had a pullback in the last couple of weeks. It trades at about 35 times earnings, down from close to 40 going into December, mid-December. And so we think that's pretty reasonable given the long runway of growth in front of them in 3 geographies now, and the likelihood of them compounding earnings growth at about 15% over the foreseeable future.
And no real concerns about local challenges going into those new markets?
No, because they're lightly contested markets. They're basically pioneering the concept in the LATAM markets. So first mover advantage with a lot of experience gained over decades in Canada. And then they've acquired a platform where they are the largest of, admittedly, a not great competitive set in the dollar store format in Australia.
And are they going to keep that name?
No, they're going to rebanner it, thankfully, to Dollarama, but they're not going to do it until they can do it with pride. That is to say that those stores physically and merchandise assortment and price point wise rival the experience the shopper would have in one of their Canadian stores, which, we applaud that decision. By the way, this is another one of these family-led companies like we talked about in the earlier segment.
All right. And let's take a look at Linde PLC.
So this is quite a different concept altogether. This is a massive behemoth.
It's the helium for the balloons at Dollarama.
Yeah, I suppose it must be. It is a big leading industrial gas and engineering company. So they're a supplier of things like oxygen, nitrogen, helium, rare gases, and so on. And they serve customers in food and beverage, healthcare, electronics, energy and chemicals, metals and mining, manufacturing verticals. They have very sticky long-term take-or-pay contracts that typically have commodity cost pass-throughs, so that insulates their margins from some of the commodity price sensitivity and volatility. Their customers have high switching costs because their facilities are usually located inside the walls or inside the premises of a customer's manufacturing plant or other facility. High operating margins, north of 30%, high returns on invested capital, north of 25%. All this creates a lot of free cash flow, about $11 billion worth. About half of that goes to reinvesting in the business, and the other half goes split off between share buybacks and dividend increases, and they are a serial dividend increaser and buyer of their own stock. Shares are trading at about 25 times earnings. That's roughly in line with its 5-year average. One of the things we like about this, although it is a materials company with an industrial exposure, you'd think it would be sort of cyclical. It's not particularly. They have great visibility into the business. They've only missed their earnings guidance once since the first quarter of 2020. So it's just a big, wide, competitive moat company that's indispensable, mission critical for their customers. And so we like that kind of visibility and
built-in demand.
What ostensibly looks like a commodity business, but actually has a fairly wide moat around it.
Okay, we're going to wrap it up there for now, but still ahead. Canada's GDP data for November is set to be released in minutes. We'll look at the numbers after the break. And our phone lines will open up soon for our first call segment. You can reach us at 1-855-326-6266. You can also send us an email, first call at bellmedia.ca. U.S. President Donald Trump says he intends to nominate Kevin Warsh as the next chair of the Federal Reserve. Warsh has served on the Board of Governors. He did so from 2006 to 2011. He was also an economic advisor for the president. Warsh was passed up for the position in 2017. Of course, Jerome Powell getting the position. And Trump has threatened to impose a 50% tariff on aircraft from Canada sold in the U.S. Trump also says he will decertify all new planes made in Canada until Ottawa agrees to approve certain jets made by Gulfstream, a unit of General Dynamics Corp. Bombardier, meanwhile, says that it has taken note of Trump's post and is in contact with the Canadian government. Exxon shares are down in the pre-market after the oil giant reported lower earnings as falling crude prices weighed on profits. The results did top Wall Street expectations and production hit multi-decade highs. The pullback comes after Exxon shares surged to record highs earlier this week. And taking a look at the U.S. futures, we are shaping up, could be a down day today. We'll see what happens, but right now all the indicators are in the red. You can see the Dow off by 0.5, NASDAQ by 0.7, and the S&P 500 by about 0.5 as well. Well, the day Oshawa, Ontario auto workers have dreaded for months has arrived. GM Canada is cutting a shift at the city's plant, costing more than 1,000 workers their jobs. CTV's John Vedavalli-Rao has more.
At this GM plant, the plunging temperatures outside match the mood of its workers feeling left out in the cold.
Feeling bad because you got bills to pay.
At the Oshawa plant, 500 full-time GM jobs are being cut, along with hundreds more in the supply chain.
I feel really bad. My son's losing his job. He was hired in 2022.
Back then, a third shift was added amid heavy demand for the Chevy Silverado trucks built here. That extra shift, though, is being eliminated on Friday. GM announced the change was coming 8 months ago, not long after the U.S. president brought in tariffs aimed at the auto sector. In a statement, GM confirmed Oshawa Assembly will return to 2 shifts of production, but adding it's also continuing preparations to build the next generation of gas-powered full-sized pickups, reinforcing Oshawa's future. Still, while GM says it's committed to staying, the union says some truck production is being shifted to this plant in Indiana.
It's devastating news. We have a large portion of our membership that won't have a job come tomorrow morning at 6:30.
It's just the latest blow after GM last year idled this plant in Ingersoll, Ontario, and Stellantis shut down a plant in Brampton. Hoping to give the sector a boost, Ottawa has agreed to potential future talks with South Korea that could include automaking. According to Hyundai and Kia, they sell annually around 250,000 vehicles in Canada, yet don't manufacture here. Still, some think a deal could draw the ire of the U.S. president.
Trump is coming after investments that are going anywhere other than the United States. So to announce a $3-4 billion investment in the Canadian market right now isn't exactly going to help the image in the United States, and it might put a target on your back south of the border.
Meanwhile, some at this GM plant are hoping the third shift could be reinstated if Ottawa reaches a trade deal with the U.S. Jonathan Valley-Rouse, CTV News, Oshawa.
Stats Canada has just released the GDP numbers for November. Real gross domestic product essentially unchanged in November, following that 0.3% decline in October, as contractions in goods-producing industries offset expansions in services-producing industries. Let's bring in Brian Madden, Chief Investment Officer at First Avenue Investment Council, for his thoughts on this one. We're just getting these numbers literally as we talk, Brian, so it's kind of a quick reaction, I guess. Unchanged. What do you think of that?
Yeah, I mean, unchanged, I think, is below the street expectation going in. Unchanged, obviously, is below the run rate trend of growth in the economy. So we obviously have some slack and excess capacity. The fact that the weakness is deeper in manufacturing, and particularly in durable goods and big ticket purchases, not that surprising. These are your classic corporate confidence tells, and corporate confidence has been rather rattled by trade policy and geopolitics, and probably export markets are being weighed upon in some of these goods-producing sectors as well. So
yeah, I'm just
not a good news story particularly.
No, I'm just looking at some of the numbers here. Durable goods up by 1.9%, manufacturing after that 2.6% drop in October. Transportation equipment, machinery up by 3.8%, machinery manufacturing up by 2.5%. Motor vehicle parts and manufacturing down 6.4%, but that was apparently largely constrained by the global semiconductor shortage, not so much the tariffs or anything like that, but still. And manufacturing, at least in Ontario, that's a...
Yeah, I mean, this is a big employer, and obviously the multiplier effect on auto sector employment is huge. By some estimates, it's sort of 8 or 9 jobs directly in the auto OEMs are supported by, 8 or 9 jobs in the broader economy are supported by each auto worker job. So, yeah, that data is telling and concerning. If there's a silver lining, the services sector sort of muddled through to a bit of a gain. All of this is a little bit at odds with the jobs data, though, actually, which has been coming in fairly strong in 3 of the last 4 months. So a little bit hard to square that. But needless to say, the economy is sluggish, and probably this is what the Bank of Canada was seeing and having moved preemptively and more decisively than the Federal Reserve has, because there is more slack in the Canadian economy, and these numbers bear it out, than there is in the United States economy, where the AI miracle is really the driving force that's sort of holding the economy in good stead down there.
Yeah, the retail trade was up 1.3%, but food and beverage was a big chunk of that, 2.5% increase, and of course that was because of that strike in BC had an impact on the booze sales there. And I think a lot of people were making up for lost time in November businesses and that, trying to get resupplied and restocked. So that kind of, it skews the number as well. So it's not. Now, just looking at the advanced estimate here, it says 0.1% increase for, they're estimating for December, but they were their street was 0.1% for November, and they didn't hit that. So
Yeah, I mean, so all of it probably rolls up to no growth or very sluggish growth or slightly negative growth for the fourth quarter when we see it all, ink dried on the page. So, what is 2026 going to have in store? That's obviously backward looking. The markets are forward looking, and so I think the market is expecting that some of the lagged effect of the rate cuts and some of the federal fiscal policy stimulus is going to start to bear fruit and take hold and reinvigorate economic growth, which is slowed to stall speed in the fourth quarter here.
All right, we're going to take a break on that note, but still ahead, Canadian media producers are in Ottawa this week for the annual Primetime Conference. The weather might be cold, but the media industry is hot. I'll tell you why after the break. And of course, our phone lines are open. Brian Madden is taking your questions. Call us at 1-855-326-6266. Email firstcall@bellmedia.ca. So what happens when Canadian-made content starts punching above its weight on the global stage? You get Shoresy. No, you get the breakout streaming series, Heated Rivalry. It's becoming a case study in how domestic production, cultural policy, and audience demand are converging to reshape Canada's media economy. CTV's Rachel Aiello has more.
The breakout Canadian star of Crave's original hit series Heated Rivalry was back on home ice today.
Hudson, how are you feeling tonight?
Hold on, don't ask questions.
Hudson Williams hit the red carpet at a major media industry conference in his character Shane Hollander's hometown of Ottawa. Embracing the show's soft power.
How's that for soft power?
Okay, this is soft. This is true soft power.
Prime Minister Mark Carney.
Congratulations on creating a story that has struck a chord with so many across this country, around the world. Because of you, cottage season will have a whole new meaning this summer.
He may not be the most sociable.
The drama about a pair of pro hockey players, rivals on the ice and out of their skates, secret lovers, is a Canadian production to its core. From most of the cast and the soundtrack to the product placement.
I think, we've set the bar very high, but we've shown to people that it is achievable.
In just 2 months, Heated Rivalry has become the most watched and rewatched original series produced by Crave, a subsidiary of Bell Media, which also owns CTV, with fans around the world celebrating the show for casting hockey and queer joy in new light.
It's just showing that because of the investment in culture, you get to have a heated rivalry. And without that, you probably wouldn't have it.
While those behind the show say they couldn't have imagined the response, they're ready to score their next homegrown hit.
We're going to continue to and elevate, making big, making bold, making authentic, not shying away from specific, not shying away from big C Canadian content.
Heated Rivalry has already been renewed, and as showrunner Jacob Tierney hinted to me tonight, Ottawa is set to be a central plotline in Season 2. Rachel Aiello, CTV News, Ottawa.
With inflation still squeezing household budgets, Canadians say cutting grocery costs now outweighs concerns about housing costs, according to a new Nanos research poll. CTV's Alex Carpa has more.
Hard to make decisions.
A trip to the grocery store is not an easy one for Ben Nye.
It's really expensive here.
Soaring prices at checkout are forcing him to carefully consider what meals he can afford to make.
That's not bad. It's $4.99.
Being currently unemployed and searching for work has made it a struggle to pay the bills.
As a consumer, we're being hit hard, and it's being difficult for us to actually be able to afford anything anymore.
Nye has even resorted to selling many of his things just to cover costs.
It's difficult trying to make ends meet.
Like Ben, many are feeling the impacts of rising grocery prices. A new survey finds that the biggest concerns around costs for Canadians is right here at the grocery store. A new Nanos research poll for CTV News finds grocery prices worry Canadians more than housing costs as inflation continues to rise. More than half of Canadians say groceries are top of mind when looking to save money this year, followed by housing at almost 25% and healthcare at nearly 10%.
It speaks to the pressure that Canadians are under and how groceries are at the top of the list, significantly ahead of things like housing and healthcare and fuel and entertainment, all those things.
But experts warn that relief may not come anytime soon.
The story on tariffs are going to continue as we're trying to renew CUMSO with a very unfortunate negotiating opponent in the United States. Could be looking at, a bad year next year as well.
Let's try this.
As prices continue to climb with no end in sight, Nye says he will do whatever it takes just to stay afloat. Alex Carpa, CTV News, Winnipeg.
Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets. Raymond James analysts upgrading SanDisk. We'll tell you why after the break. Let's take a look at some of the notable analyst calls and recommendations. First up, SanDisk. Jumps in pre-market trading set to extend gains after rallying 127% this year as the computer hardware and storage company's second quarter revenue beat expectations. Raymond James analyst Melissa Fairbanks upgraded the stock to outperform from market perform, with a price target set to $725, implying a 34% increase from last price. Deckers Outdoor rises 14% after the owner of the UGG and Hoka footwear brand raised its annual earnings and sales forecast, beating the average analyst estimate. KGI Securities analyst Jenny Liu raised the recommendation on Deckers to outperform from neutral. PT set to 129, implying a 29% increase from last price. And for more on SanDisk, we're going to talk about SanDisk, bringing back Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. It's suddenly come out of nowhere again. Like it just hovered along and then everybody's realized, we need these.
Yeah, so we started to see this really in earnest in December. And of course, we at our firm, we've had exposure to this AI theme in various ways through the foundries and through the chip designers and then, upstream of that with power producers and uranium and so on. But in the tech space, the tech hardware space, really the focal point was the AI compute chips. So, your NVIDIA, obviously the poster child for the whole AI rally for the last 4 years, Broadcom and the like. But what we're realizing now is there's been a rotation of funds away from some of those names and into the more mundane applications like memory chip producers. So, your Texas Instruments, your SanDisk and the like, Micron, are having just monster rallies in December, probably the market quite correctly anticipating very good earnings reflecting tighter supply-demand conditions in this memory chip part of the semiconductor industry. Spectacular run in all, and we don't own it, but we're obviously watching it with some interest. So there's probably something fundamental happening here, sort of the relative tightness in this part of the semi space, and also flow of funds is just sort of pouring gasoline on the fire here.
Yeah, and I think, people, I know inside not so much, but SanDisk, when you think about it, you think about your memory cards for your old cameras.
Well, yeah, right. And
like
so
that was I think a lot of people looked at it like that, but this is
yeah, and they've evolved obviously into sort of higher spec applications, but it's certainly relative to these very, very, very high spec chips that NVIDIA and others on the forefront of the AI compute capabilities are producing. This is a more mundane application, but nevertheless, it's mission critical. And when you need them, and you get pricing power and demand surges.
We need light switches to make the lights work.
Amen.
Okay, when we come back, Brian Madden, Chief Investment Officer at First Avenue Investment Counsel, takes your questions on First Call. Time for First Call, and we'll head to the phones for that. And it's Charlie from Montreal. Charlie, how are you?
Hi, thanks for taking my call. Brian, I'd like your opinion on Lululemon. I started a position when it was what I thought bouncing off the bottom, but as you can see, it pulled back again. Would you buy more to average down, or do you think this is going to continue going down? Thanks.
Thanks for the question, Charlie. We don't own Lululemon. We have owned it in the past, but we're not really dusting off the file and doing work on it and thinking to re-enter the name. It's got some problems with product assortment and merchandising and leadership. Most recently, of course, we've all heard about these see-through leggings.
And the instructions that now come with them?
Yeah, and I think that's just a very bad customer service blunder to sort of pin your product error on a user error in sizing or not wearing the right undergarments with them. And it's just symptomatic of a company where they seem to have lost their direction. I mean, this used to be a really hot category-defining manufacturer and retailer, but now other upstarts are gaining market share, and I think they need a complete product kind of reset and strategy and go-to-market approach. And not surprisingly, the founder is in there agitating again for change. So it's a messy situation. It's a show-me story. Probably they can fix it, but we'd have more conviction if they start fixing things before we start a position, frankly.
And you've got Elliott in there putting some pressure on as well.
That's right. That's right.
Is that a good or bad thing when you're getting tugged into, when you've got advice coming from the founder and a big investor like Elliott?
Well, I mean, if they're doing the wrong thing and you've got two voices in your ear, both of whom you really should or have to listen to, whose ideas maybe are better than yours, that pressure can be helpful. So it's not necessarily a bad thing to be invested in a company where an activist or multiple activists are involved. It's just that the fix here is not going to be easy, and it seems like they're a bit entrenched in doing what they're doing. So we just think the risk reward is not that great here, even with the activists getting involved.
Okay, let's get to another caller. Bob from Toronto.
Yeah, hi, Roger. Hi, Brian. Brian, I'm just wondering what your thoughts are on Google. I know they come out with their numbers next week, and given what happened with Microsoft yesterday, I'm just wondering if you think Google will experience the same fate. Thanks so much for your comments. Appreciate it.
Yeah, great question, and thank you for that. So I'm going to answer it in two parts. So the longer term thinking in our firm on Google Alphabet is it's a great company. We own it in our momentum mandate, have for years. Obviously, it's the category-defining leader in search, monetized through advertising, the dominant player in digital advertising. Beyond that, there's a cloud business and YouTube and Waymo and various other things, but mostly it's exposed to the search and online advertising. There was a fear about a year ago that they were going to be dislocated with some of these ChatGPT and other sort of AI things that would make their form of search obsolete, but they have very much stepped up their game and sort of made it AI inside, native to their search engine. Beyond that, there's Gemini and other things. They're building chips, which are performing very well. So a lot of good things here. To the short-term focus, could it trade down on earnings, even if the earnings are good? Yes, absolutely. Entirely a possibility. That's exactly what happened to Microsoft. And in fact, we're seeing it fairly broadly among some of the stocks that have been really stalwart performers over the last 3 years. They're putting up good numbers. And in the short term, it's just not good enough. And so there's a bit of a sell the news moment when the news comes out. Our counsel to you is if you own the stock, continue to own it. The long-term future looks very, very bright for Alphabet.
Okay, let's get on to some emails now. This one's from Paul. It says, good morning, gentlemen. We'd like Brian's take on Agnico Eagle. If he were holding it now, would he keep on holding it for the next year or so? With the USA in a state of disarray and apparently just getting worse, would gold keep on its march upward? Your comments greatly appreciated.
Thanks for the question, Paul, and a timely one. We do own Agnico. We bought it in April of 2022, shortly after Russia invaded Ukraine. The thesis was it's probably the best senior gold producer in the country by way of political risk. The mines are in Canada and Australia and Mexico, all good mining jurisdictions, and Finland. And the management team is good and credible, and there were good organic growth prospects. Obviously, the stock is re-rated massively along with the commodity. We continue to own it. The underlying thesis remains intact. We did trim about a third of it, so that's to say reduced our position size by 1/3 last Friday. Just thinking the gold market is getting a bit frothy, the volatility is high, the intraday ranges are high, and these are dynamics that can often be precursor to a correction, possibly short and sharp, possibly longer and deeper. We don't know, but probably there's less, well, mathematically there's less upside in the stock from here than when we bought it, but it still remains a core weight in our dividend growers portfolio. And we're hopeful in the upcoming earnings release, we're going to see a long overdue dividend with the monstrous free cash flow they're likely to generate at these gold prices, and having delevered probably to zero net debt after that Kirkland acquisition they did a few years ago.
Okay, we're going to sneak in one more. This one's from Sharon. It says, good morning. What do you think of Fairfax Financial for the next few years?
Thank you, Sharon. We're shareholders of Fairfax, again, one that we've owned in our momentum mandate for about 3 years, bought it in late 2021. So maybe that's more than 3 years, but in any event, leader in property and casualty insurance in Canada and globally. The name itself is a mnemonic for fair, friendly acquisitions, and true to form, it's what they do. They're serial acquirers of insurance companies. The founder, this is another founder-led company, Prem Watsa, is sometimes referred to as Canada's Warren Buffett. So the investment portfolio is another nice kicker. They're reinvesting in the big bond portfolio at higher yields. So we like the stock.
All right, got to wrap it up there, but thank you as always, Brian, for joining us today. And he's up next with the markets, with the open, the markets as well. He'll have, of course, they open about 30 minutes from now. Have yourself a great weekend.